So in the last video, Alex checked his credit score and saw two completely different numbers. One showed 720, another showed 650. That's a 70-point difference. And in lending, that can mean higher interest rates, higher monthly payments, or even rejection. Same person, same finances. That should not happen. So why does it? Because you don't actually have one credit score. Most people think they only have one score. They don't. You can have multiple scores across apps, lenders, and different credit systems. And sometimes, they don't even agree with each other. In Canada, your credit history doesn't live in one place. It lives in two: Equifax and TransUnion. Two companies, two separate databases, two different financial pictures. So let's go back to Alex. He has a $2,000 credit limit. One bureau still shows a $1,600 balance. That's 80% utilization. But the other bureau already updated his payment and now shows only $400 owed, just 20% utilization. Same person, completely different risk signal. And scoring hasn't even started yet, because credit reporting isn't perfectly centralized. Some lenders report to Equifax, some report to TransUnion, and some report to both. So one bureau may receive updated information earlier, while the other still shows older data. And this is where things get messy. Most lenders report roughly once a month, but not all on the same day. One lender may update on the 6th, another on the 20th. So for days, or even weeks, one bureau may show high utilization while the other shows lower debt. And during that time, you can look riskier than you actually are. But here's the crazy part. We still haven't talked about scoring yet. Because even if both bureaus had identical data, you could still get different scores. Why? Because there isn't just one scoring formula. Different lenders can use different scoring systems. You may hear names like FICO, beacon scores, or bureau-specific credit models. And many banks also use internal risk systems. They don't just look at your score. They may also consider your income, debt levels, banking history, and past account behavior. So even with the exact same credit data, different formulas, different lenders, and different risk systems can all produce different results. So now imagine this. You open an app and see 720, but the lender may be looking at a different bureau, a different update timeline, and a completely different scoring model. And that can influence your approval, your interest rate, and how risky you appear. So the real question becomes, when you apply for a mortgage, car loan, or credit card, what are they actually looking at? In the next video, I'll break down what lenders may actually prioritize and why the score you see in an app may not be the score that matters most. So if you actually want to understand how credit works in Canada, subscribe. Because most people are making financial decisions without seeing the full picture.